All right, let's do this. Yes, the Wednesday presentations are always recorded, Mark, and they're typically available over the weekend, either on the DTS Free Stuff page or on the mirrored site at YouTube. All right, everybody, let's get going because as usual, I overdo it a little bit and probably have a full hour of material. Always want to get done by 6 o'clock so nobody's ever thinking that they have to listen to more than an hour of me talking. The email that went out had a little blurb on it. Let me just read that real quick. It says, today my discussion may have a little different tone to it. There are a wide variety of people attending these presentations. Some of you are brand new to DTS and brand new to the market. Some of you are subscribers to DTS or seminar students, but I think the vast majority of you are not brand new to the market. You've had some experience. Today will be very focused, looking at some charts, and I will be asking you some questions about the charts, and I'm going to use some generic technical terms. These terms may not meet my definition, but I'm going to use them in a generic sense so I can ask you some questions to help make my points. So as we go through this, it's not a seminar-like discussion about what the setups are. It's more how do you look at them and how do people typically trade them and why perhaps you may have issues if you're trying to make money on some of the moves that you're getting. So I think it'll be a very informative, this is a very technical presentation. As you know, everything I do is 100% technical. If you come to the Friday free events that I do, the free half-day seminar, which it's going to be, the next one's not going to be for about 3 weeks or so. But if you come to the next one, I discuss on there why I'm 110% technical and why fundamentals and things like economic data are not things that you should be looking at, as they will not help you make any money. The concept today in general, let's go here to the first slide here. This is, what was emailed to you, so it's just there for fun. You've read that already if you want to, or you don't have to read it. A couple of concepts here. Too many try to make money on rare big moves. That's fine when they come, but if you enter them in a way that requires a huge move to make money, it becomes low odds, and then you have to get a fair amount of those home runs in order to make money. And more importantly, when you do get that home run, you kind of have to stick with it and take all the money from the home run, which is difficult for people to do. So a lot of people who resort to kind of, I guess you'd call it almost kind of a cookie cutter way of trading, where you see some generic stuff, they are tough to find consistent winners in a lot of that, and at least ones that have big enough moves for you to make your money on. And then when you do, the problem is most people don't take the money. They take a small part of it in order to cover prior losses, and then they go on. And when you think about it that way, you get yourself set in a way where you're actually trying to break even. I don't know if some of you ever realize that, but if you ever get unconfident because you lose some confidence because you have a couple losing trades, and then when you get a winning trade, you say, well, I'll just use this trade to pay for the losers and I'll start over again. Once you do that, you can never make money because you're just simply trying to break even, and you have to get beyond that. The classic strategies, all that cookie cutter garbage, those type of things, they are more things that teach you kind of the wrong way to trade, besides being just terribly incoherent and terribly lacking in detail. They are all more or less based on these bigger moves that do happen naturally. You look at a chart, and what people tend to do is to look at a chart and see some big move that occurred up or down, and then say, oh, let me go see where that started. And okay, so this is how you make money. You just take this move. And it's true that a big move starts from this setup here, XYZ, whatever it is, but it doesn't mean that every XYZ setup is going to create a big move. So especially if you don't know what you're looking for. So you try one of the setups, doesn't work. You try another one, it doesn't work. You try another one that starts to work, you take some money, and you move on. And you have to get beyond that level if you really want to make money on a consistent basis. We're going to get right to a chart here and start looking at a couple of things. This is a longer term position. Let's review this trade. It's a long-term position. This is WB. I always joke around and call it Warner Brothers. It might have been Warner Brothers. Then I called it Wachovia Bank. It actually, I think, is some software company. I'm not even sure of the name of it. I think I'd know it if you told it to me. But WB weekly chart. So as a longer-term trader, we're getting our strategic concepts from monthly and weekly charts, basically. I'm not talking about swing trading where you're maybe using a daily chart. I'm talking about a little longer term. So this is something that you may consider to be a weekly buy setup that's forming. All right. And this is a nice weekly chart. I like it. It's something that's sitting on some minor support, blah, blah, blah. It's had a nice new uptrending move, strong move, pullback coming here. All that looks good. Naturally, I'm kind of focused on this setup that's going to come up right in here. Now, naturally, if you're looking at a buy setup, and again, this is where I'm just using a very generic term. This is not Paul's DTS. This is just a generic buy setup like you'd find if you got a back box of Cracker Jack and you found the little book of technical definitions at the bottom of the box. Naturally, that buy setup would be over the high of some bar, and you can see it probably triggered in here before. I would have never taken this up in here like this. But let's say you passed those because you were smart enough, whatever, because this bottoming tail here would have stopped you out. So let's say you're using this big bottoming tail bar, right? We all like bottoming tails. If you've been around any technical analysis for more than a couple hours, you've probably heard of a bottoming tail. So let's say we're going to use that right there. So we're going to get in over the high of that bar, stop under the low of that bar. So there's our setup. If we did that, and you can look at your own charts if you want to click on them. This is WB from just a month or two ago. You'd be entering over 50.03 would be the exact to the penny number, and a stop under 44.01. Okay. If you were going to target a target there, you'd maybe be looking at the prior high up here on this chart that's up in the 60, the exact number again would be 63.55. Just using the exact numbers for fun here, okay? Does everybody get the general concept here? That would be the typical way that you probably understand if you've looked around at charts at all, if you've read some books. It would be called kind of a classic buy setup. Does everybody have any questions at this point? Don't feel bad if you want to ask a question. What do you think of this? Do you like this? Is it a good setup, good chart? Do we not like it? Is there anything wrong with this? Give me some comments. Whether you're new or old, what do you think? I'm going to wait for you. I have 52 minutes to sit here and just wait for some answers. What do you think? Would you do something like this? Is it a good setup in general? Don't like it? What don't you like about it? It's below the 20? Okay. All I can do is give you a couple quick answers. Below the 20 is not relevant at all. That's not even a concept that I would have considered as a plus or minus on this chart. I'm not, trying to be difficult. I'm just saying there's nothing wrong with being below a rising 20 at all. That's perfectly fine. Look for a better entry. That's an interesting answer. Prior high was intended. Combined with the daily, it was a strong. Okay. And it would have stopped. It would have stopped out already. No, not this one here. Wouldn't have. The one I'm looking at right here would not have stopped out. The ones before I said, yeah, they would have. Yeah, obviously, right. Bottom retail bar looks like a breakdown. No, I wouldn't look at it that way at all. Okay. Just want to get some comments on there. So here it is a few weeks later. Like this is today. This is what it looks like today. And as of today, it's at 52.49. So it's taken, a couple, 3, 4 weeks to get up to here. And that move would be a 0.4R move. Wait a minute, Mark's comment, consolidation not broken above it. So Mark, you'd want to wait until you're all the way above all this stuff up in here, right? That's what you're saying? Okay. That's a good comment because it's one of the things I want to address here is just that. So if you did take that there, it's a point. Now, 0.4R for those of you that are maybe newer, it means your risk reward sort of, right? In other words, the stop on this we said was whatever it was. It's like $6 or something, and then the move was $2.50 to here. So you didn't even make 1R move yet. Okay, that's right, Alfred. Very nice moving averages. I agree. And if you got all the way up to the prior high, based on those entry numbers, that would be about a triple your money, about $3,200 on $1,000 risk. Does all that sound right, everybody? So if you did take this entry in here as of today, you're up a half of an R, and your target up here would be about 3 R's. Okay, R's being your risk multiple. If you risked $1,000, you make 3,000 on a 3R move. Okay. Again, I don't want to get, hey Steve, it's a good comment, but I wouldn't call that climactic, Steve, and I'll gladly, talk about all these questions. And the reason I wouldn't call it too climactic was because it's kind of a new breakout. See, if this had been uptrending forever, and then it did that big run, then I'd be a little concerned about it. But it's kind of a newer move, so it's kind of a breakout move. And as long as you wait for a sufficient pullback, I think it's a good chart in there. So that's where it is now. Let me give you my comments here. I think this chart is a phenomenal chart, strategically. So again, you can disagree with me. This is exactly what I look for. As a matter of fact, it is what I look for because this is an actual trade. I'll show you in just a minute. All the comments about moving averages are not appropriate. I think this is exactly what you want to see. This little bottoming tail is not a breakdown because you're sitting on minor support. This little, and I don't want to get too much into this, is not the point of today, but this little tail actually is a shakeout. It washes out the sellers that are still in there. That's what you want to see to go long. You want to wash out the sellers. Now, not every time that happens is it a little shakeout bar. In this case, it is. That's what you want to see. That's what I actually waited for in that case. Strategically, I love this chart. It's great. The entry I showed you is terrible. And it says, yes, that is the standard entry. It's what you're likely taught if you read books or do things. But if we stay sideways, you're never going to make more than a 0.4 move. Now, was it Bruce or Mark? You made a comment you want to break above the base. Now, on one hand, I see the sense of what you're saying because maybe you felt this entry was kind of in the middle of things. But the problem with that is we have to do better than that because that's even a worse entry from a risk-reward point of view, right? Was it Mark or Bruce? But so I get your comment, but we just can't make money doing that. What I like to say, Mark, is if you want to play the market, if you want to trade the market, we have to be better than that. Right, you have to be. Can you agree with that comment? That's just like kindergarten stuff. Okay, here's an $8 stop, and maybe I'll make $6. We got to do better than that. I'll tell you how in just a minute, or at least I'll give you a concept of how. So, as I said, this actually is a setup I do really like a lot, and there's a setup. Boom. This actually was a trade I did, and this went in the long-term trader. This is one of the subscription services at DTS. You can sign up for a long-term trader letter. It's not about that. I'm not here to tell you to get that. I'm just saying that it says I like to use actual trades for examples because anybody can go back in history and find a chart that did something they thought was appropriate and say, oh, look what this chart did, blah, blah, blah. Well, who cares? I can find one chart that does anything in the world. So now that in real time I was doing this because the setup was exactly what I wanted to see. Hang on one second. I have a couple notes here as I'm going. I just want to make sure I'm hitting them before I get too far ahead of myself. Yeah. So this here on the right is an actual copy and paste from the letter that went out. This went out on June 8th. This wasn't that long ago, just beginning of the month, June 8th, new position. And here is exactly a copy and paste from the letter. Long over 47.80. Stop under 46.90. Notice these numbers are just a little bit different than the numbers that I used as the quote unquote standard cookie cutter example on the first slide. It was designed to make more money on an ordinary move than the priors would on a home run. What do I mean by that? Well, I'm going to show you in a minute, but in simple terms, me with this entry getting to your entry or a typical trader's entry, I will be up almost twice as much money just getting to their entry before they're even in the trade. That is what I mean by making money on ordinary moves. In other words, Mark, that base you were talking about, me just getting to the top of that base. And how do you do that? Here's the weekly chart. So the entry was taken on the bottom of the range. Once this range sets up, and once I have this little shakeout bar in here, now this becomes a very firm support area to me. So on one of these trips to the bottom, and again, this is something I had on a watch list for several weeks. You don't just put it on, so I'm watching, looking for the right entry, looking for when I want to get something, looking for market timing, all that good stuff. And then when it comes down to the bottom, here's the daily chart. So this right in here at the beginning of June, if I go back there, that is that right there. The weekly chart comes to the bottom, come to the daily, boom, and find an entry. Entry 47.80. If you click on your chart, you're going to find that the high of this bar here before the green bar is actually 48 something. In other words, the entry was even before the high of that bar. Stop 46.90. Now that's the precision that you like to have in order to take trades like this. Now, yeah, probably the higher bar was over 48. And the high of that bar is actually somewhat of a meaningless number. The actual entry was taken from an hourly chart because I'm in this very precise area. Look at it. Look at this area down here. So you can see when you come down to this chart, waiting to get above this, well, I'll show you on the next slide here. Boom. Me, entry, boom, 3 weeks later, where somebody else may be entering is actually my target one for a third. If I get to the prior high, it's a 17.5 hour move. In other words, this high up here where you, I'm saying you meaning average Joe trader, got in with the entry I showed you before, that was a 3 hour move. This is going to be a 17.5 if it gets there. They don't all get there, but here's my point. My point is that I'm making money just staying sideways, right? If this thing never takes off, you know what? I'm making money. If this thing now stops out, you know what happens if this stops out? Yeah, I didn't read this slide, my apologies. Now, when I get to where everyone else's entry is, I call it target one. That's what was taken on 625 at 52.41. 1/3 of the position hit target one, which was the top of that base. That's a 5 hour move. 5 hours. Just getting to the entry point that somebody else would use. Now, if the rest stops out, now let's just say from here, and this is a live trade right now. This is going on with me. This is, it's in the letter. We're on target one's done. Stop's not changed. If this comes down and the rest stops out, I'm still up 1 hour if you do the math. You're down 1 hour. If this goes to target two, it's 17.5 R on that 1/3 of the trade, not for the whole thing, but for that third. When you do the math, and you may say to me, okay, but doing what you did, it may stop out more often. I'm not sure I even agree with that necessarily, but assuming logically it's true, how many stop outs could you withstand though when you're making 5 times the money to target one or target two, right? Does that make sense what I'm saying, everyone? At least from a logical point of view. See, there's always this trade-off in trading, right, between your accuracy, i.e. how often you stop out, and then how much money you make on the moves, right? But it's not a hard analysis. Now, there's some close calls sometimes. You could show me the setup where you say, okay, you're going to make twice the money, but gee, you're going to stop out twice as often. Well, that kind of breaks even then. But I can tell you here, looking at these charts, there's no way that trade stops out 5 times more often, right? Chris, you might have joined a little late. I did explain it. I just wanted to let you know I'm not just throwing terms around. It's like your risk reward. So it's like the after the fact risk reward. So if you had a $2 stop and something moves $6, we call that a 3R move. And if you share size properly and you had a $1,000 risk based on that $2 stop, then you'd make $3,000. So it's an R multiple. It's the multiple of your risk that you're making, which is really the only way you can measure a trade, because you may risk $100, I may risk $2,000. Who knows? Yeah. Oh, no problem. Okay. Yeah, I want to make sure everybody's following along. So the theme of tonight: make your money on normal moves. In other words, if you're going to take the breakout above this area, like Mark said, you could argue that that's going to be more reliable. But you're expecting and demanding you get the home run move to go to a new high, or at least to the prior high, to make any money. And you're making a couple of hours. If I'm going to take something from the bottom and get to the prior high, I want to make a lot of money, not just because I got to pay for any losses I have along the way as well. So let's do it again with another concept here. And this is going to be another trade from that I have. It's in the long-term trader. And I only have 4 things in there. I'm not showing you the winners. That's all that's in there right now. STZ weekly chart. Oh, by the way, I was going to say I'm not showing you the winners. If you want to, if you are curious, there is just some information on the long-term trader. STZ. This is entered before that one. This is a little while back. And the same thing here. Now, you may not even like this chart. I get it. I'm not in love with this one as much, but if you wanted to take this as kind of a breakdown, this sideways breakdown, you'd be entering underneath this area right in here, or maybe waiting to this area right in here. And it wouldn't have even been entered yet, right? This wouldn't have even happened yet because we're still waiting, for it to break down below there. You'd be stalking for a breakdown, and that would end up being about a $26 stop. Keep in mind this is a $237 stock. So, and you'd probably be looking for the target area down in here, down to this kind of quasi support area down in there. Well, again, this was a trade that was taken a little bit differently. This was back on March 26th. This has been around for a little bit. And here the short was under 239.60, stop 242.50. It's not a $26 stop, that's like a $3 stop. And I'll show you where that was. Again, on the weekly chart up here, as we set up this resistance area in here, it was coming right into there. Once, twice, knock 3 times, there you go, third time up there, and looking for an entry up in there and taking that. Now, again, coming down to find the right entry. Once I'm sure I love my strategy and it's very precise, I get a little more detailed and come down to the daily chart. And that daily chart entry was right in there. Like this entry a lot. This is a great entry, just a great entry, period. To be wrong, this would have to go up over this stuff in here, which is also at a prior weekly high. So there's a lot of reason to think that it's not going to do that. If it's not going to go higher, guess what? You make money if it goes lower. And the timing was good on this because it had a kind of an immediate drop. Now I was going for a target, down. The original target I think was 221. I forget right now, but it dropped fairly quickly, and I made the decision, a management decision, to trail the first target here rather than getting it down to here. Now it wasn't a huge target on this one. It was under 2 Rs. But there's a whole lot of things that I want to explain to you that go into the management process. And one of them is this simply, is that this is what I call an aggressive trade. And rather than getting the whole stop down, most people tend to think, well, if it moves in my direction, matter of fact, give me a 1 if your thought process goes like this. As soon as it moves in my direction, what I'll do is I'll just get a stop down really quick, and that way the whole thing is kind of break even or in the money. Is that a thought process a lot of you use? A very common one. I mean, and there's some good thoughts to that because people don't like to go red, right? You all like to stay green, but unfortunately, the emotional desire to stay green is not always consistent with making money because sometimes things have to go red a little bit to really get green. And what I prefer to do is something a little different. And this is something that you may pick up and use immediately if you like it. But rather than me, because I have the desire to, I mean, I know it's better to manage properly, but everyone has that desire. And also if you're managing a whole account, there's a second issue that when you're managing the whole account, you want to be safe to take another trade. And to be safe, if this still has a full R possible loss, and you get another trade, and you have a possible 3-hour loss in the whole account, you kind of don't want to take any more trades. So there is some benefit to getting things to, quote unquote, break even. But managing any trade like that is very detrimental in general. The stop's up here for a reason. So what I tend to do is take a little off the table. So I take a third off the table. And now even at the original stop, this thing's almost break even. It's not quite break even, but it's a very small loss. And I also know the chances are at some point I'll be able to get the stop down lower. So I take a little off the table on a quick move like that and then say, just forget about it. The other thing I wanted to do is that in the long-term account, I am kind of balanced between being long and short. And one of the things I want to do, if I can, is to build up short positions, the back third, 2/3. So when we have the big drop, I'm ready in stuff that's ready in the money. So all these things come together to make me say I want to take that target right in there. But again, what I want to point out to you is that the topic for tonight is that on this chart, dropping from here to here is no big deal. It's just what you would expect it to do. This thing is just kind of meandering around sloppily. And you'd never make money trying to short any kind of weakness in this. You make money by understanding when to short just off the top, and then you make money to here. This move was half of what the stop was going to be on the other trade I just showed you. So then we, yada yada. I almost got down to target 2 here, and unfortunately I didn't. And I decided to live with it. I wanted to, this is going in earnings. It did earnings today. I wanted to hold it in earnings, hoping to get a big gap down. It went up today, but it's pretty hopeful because that was earlier today, but it closed pretty weak today. So I'm probably just going to leave the stop alone and let it just play out. But it came down. It went red on the day. I mean, the bar was red today, but it was still above yesterday on the gap up. So it's looking good. I like the way that's looking. So again, understanding the chart well enough that you can comprehend an entry that lets you make money from a normal move, not having to have a home run to make any money at all. Let's look at another concept of what I mean by normal moves. And this is on a day trade now. This is from yesterday. Again, I'd like to always use recent trades. And by the way, those in the long-term trader, they are the most recent, except for G Pro, which is doing great. So I'm not hiding that from you. It just didn't have anything to show on that one. IRM 60-minute chart from yesterday. Here's the question I want to ask you. So the daily chart here, it wasn't a good uptrend, and now it's just fading away. It's kind of, to me, the daily chart is a moot point for a day trade. Again, not for long term, but for a day trade, this is just kind of neutral right here. It wasn't an uptrend, but it's forgotten all support levels. But here's the question I have for you. Take a look at the 60-minute chart. And this is how it, now this trade was yesterday. So this is what the chart looked like yesterday morning before open. Let me ask you a question. Before the market opened yesterday, would you enter a long trade on this, assuming that it was going to break this little range and go higher? Would you do that, yes or no? Yesterday morning, before we open, say, hey, you know what? Let's just make a bet. I'm going to bet it doesn't go higher, and I want you to take the bet it does go higher. Would you take that bet? No, of course not. Would you take the bet if I gave you 2-to-1 odds? Probably still not, right? 3-to-1 odds? I mean, at some point, I guess you'd take it on a long shot, right? Well, if you're that sure that the stock's not going higher, why don't we short it? Do you ever think that way? Now, a lot of people look at this chart and just say, oh, okay, it's just grinding lower. I look at the chart and you say, you know what? The odds are very good. It's going to keep grinding lower. I call this a power trend. Does that make sense to you guys? Does it also make sense why it's in this presentation about ordinary moves? In other words, this thing is just going to do what it's done every day for the last 5 days. It's just going to keep bleeding lower. Why does the stock bleed lower like that, everyone? Why does the stock bleed lower like that? There's a very specific answer. No, that's not the correct answer. Sorry, Mark. It's true we have more potential sellers and potential buyers. That's why it's grinding lower. But this has been a very strong stock. And the fact, Mark, that it's not free falling means that there are buyers, right? If there were no buyers, it would be dropping really quickly, right? Institutional selling is close, but it's not quite right. And Roger, you're off by 1 letter. You're missing 1 letter, Roger. This is a pattern of a seller, a big seller. How do I know that? Think about it. If there were no buyers, the stock would drop quickly. If there were multiple sellers, guess what? They would be constantly battling to the point it would be accelerating lower, right? Could be more than one seller, right? It would plunge. It could be more than one. I mean, not always sure how they interact with each other. But the point is, if there's one seller, they can just kind of just very slowly unleash and let the buyers come in that want to come in and just very slowly grind it lower, right? Yeah, there's people in here buying. The dum-dums are buying it and big sellers coming in to unleash. And at some point, the big seller will say, okay, it's getting too low. I'll just back away. And that's when it'll pop for a day. And it'll probably keep on going. The rolling who? So this is what I saw when I was scanning, and I said, okay, love that chart. Let's save it for the next day. And then the next day, here's what I see. IRN up until yesterday morning. So the next day, here's what I see. So this, just so you follow me here, the end of this day right here on this hourly chart, that is right here on this 10-minute chart, right there. So I was doing some other things yesterday, and then I look over and I see IRM Pop, 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 just can't get above this little bar from the prior day, right? So how simple is it to just say, well, as we come off this high this next time, let's short it under 42.84, stop 43. The stop was up here over that green bar even, and let's just see if it keeps bleeding, right? Let it bleed. Let it bleed out, and there it goes. Just the most carefree trade. I don't even think I managed this all day other than I took a target. I hit a target when I walked away on that by the bottoming tail. Oh yeah, and so I walked away, hit that target, and then came back. It was somewhere in here, lowered the stop on the back half to right there, and then just let it go to a close. Simplest thing in the world. And again, the point of today, this is, I think it's on the slide. I keep wanting to say stuff that I've already written out here, but isn't it right here? Boom, 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 boom. Iron up to yesterday morning. The stock just kept doing what it was doing. It didn't set a record day. It didn't make the top 10 of anything. It was just boring. It was just boring. But the money you make from a boring stock is just the same. Just the same. This is the way I try to fashion all of my trading. Now, is it nice to get the home run? It is nice to get the home run. But you know how I think you should do it? Oh, before we get to how you should do it, let's go back a minute. So if you're I started off this thing by saying that there are a wide variety of people listening. Some of you are seminar students who should take and absorb this as part of everything that I teach. Some of you are probably fairly accomplished traders, and maybe you really get a lot out of this. Some of you may be newer and you see the theoretical value, but you maybe don't have the technical skill to be able to say, hey, yeah, I get what you're doing, but how do I find that? Well, that's where you need the technical skill. But here's what I want to make sure you don't take out of this, because as a new person, it could be misinterpreted. You should not, notice the word not, very important word there, you should not take away from this to just use tight stops to increase the reward to risk. That is, Roger, what do we think about just tight stops in general? Since you were the last to type the name that I recognize. What do we think about just tight stops in general? Make the stop tight. Roger went to get coffee. Nope, maybe not. This is one of the things that just amazes me about a lot of newer traders that I fail to understand. Yeah, tight stops just make you stop out more often. I never fail to understand when I'm talking to a newer trader, and sometimes by email they send me a trade, or maybe I'm talking to them or in an event, or sometimes somebody new in the room, and I'll say, that I'm not really impressed with that trade, or I don't like the trade, and they say, well, I'll do it with a tight stop. What does that mean? What does that mean? I'll do it with a tight stop. I just don't get it. It's like you're going to jump off the bridge with a bungee cord and it's not short enough, and you say, well, I'll make the cord longer. It's the wrong way to go. It makes no sense at all to me. Maybe they mean that they're going to use less risk, but that's just stupid. Right, that's the point, exactly, Caden, is that if you're trading properly, a trade is a trade, you're going to lose X amount of money. And if you do actually mean you're going to take less risk, well, to me, that's stupid also. You don't rate the trades and say, well, that's a really bad trade, so I'm just going to lose a little bit of money on it. What sense does that make? It's like that car's not even running, so I'll pay half the price you want for it. No, it just makes no sense at all. So that is just wrong, and that was not the point of this presentation. Just tight stops in general to increase reward to risk with not knowing what you're doing is just going to mean you're going to stop out at a multiple times faster rate than you are. As a matter of fact, it's amazing. So many times when people, new people, just people asking for some help, send me stuff, what I see all the time is people just using crazy tight stops or managing with crazy tight stops, and they just can't get anywhere. I mean, it didn't matter if their trade was good or bad. They just don't even give it a chance. So that was not the point of this at all. As a matter of fact, I'm a huge promoter of giving generous stops to things. But here's the key word, generous for the time frame that you're on. If you become a really excellent technical chart reader, even a pretty good technical chart reader, you can find those moment in time areas where you can say, you know what? This is like ground zero. This is where the stock, if it's going to move to here, it should keep going. And that means I don't have to give it the stop that's necessary on the monthly chart or the weekly chart or the daily or the hourly. I can use this area right here. And that should do it. And it may be slightly more likely to stop out, but it's going to make 4 times the money. And that's what I like to see. Slightly more likely to stop out, but multiple times the money. Then you have good things working for you. Tight stop does not mean risking less. All right. Second thing that I'm not trying to convey to you, just in general, to just buy all bottoms or short all tops. I mean, if you know what a bottom is, that makes sense. But the problem is buying all bottoms is a sentence. It's just 3 words. It's not a strategy. Understanding what support actually is, how to understand the 4 analysis points of support and how it works across multiple time frames, that's a strategy. So in other words, there was a lot, I look at hundreds and hundreds of charts, like go back to WB. I mean, I had maybe 10 or 15 charts on my watch list out of thousands, of hundreds, not thousands, hundreds, 1,000, 1,500 charts that I look at. And there were 8 or 10 that I liked. And then I waited for the right setup. So if you were to just go and say, well, just buy any support area, well, you could probably find what the average trader calls support on 500 stocks. And it doesn't work on most of them because it's not really support. So you have to really get a good understanding of what it is to get the bottom or the top. And by the way, there's a saying out there that you shouldn't try to get the bottom or get the top. That's a very relative concept. In terms of all-time high, all-time low, no, you shouldn't be buying an all-time high or an all-time low or shorting an all-time high. But within time frames, in other words, my goal every day is to short the high of the day. It's not the all-time high. It's not the high of the month, the week, or whatever, but it's the high of the day. So that is my goal to do that. But it's not the all-time high. It's the high for that particular day. And that's a great strategy, but you have to know how to do it properly. So it's not just randomly to say anytime you come into an area of support, you just go long and hope it works because you got a snugger stop. Okay? All of you will take away something different from this. So I just told you what not to take away. What should you take away from this? Well, it's very simple. Superior technical understanding lets you find those moment in time areas. I call it the language of charts, right? As I just said, for some of you, this may be theoretical because you do not yet have the tools to understand what I just went through. Now, again, when I went through this, I just went through it in kind of a generic sense. I told you what I did. I didn't go back and do something that would have been kind of worthless here, which is to go through every point. I went through a lot, actually, but I didn't go through every point. In other words, you have to have the whole technical background to understand just exactly why that chart was better than another chart or not better than another chart or why I liked it. So for some of you, this may have been very enlightening and helpful, especially if you kind of have some good technical skill, but you just keep going after the wrong thing. And for some of you, it may be more theoretical, like I said. And what I mean by that is that you can see it, and when you're sitting here listening to me, you say, boy, that's really great. I'm going to go do that, and then tomorrow you're kind of lost because you don't know exactly what to do. Does that make sense? I need a sip of my delicious chilled Coca-Cola. Does that make sense? You are learning and do not yet have the knowledge to find and execute exactly what you see. For some of you, this may be helpful as you can find these moments. For some, you may be in the middle. It may be frustrating, but at least you see the goal. I think that's an important one too. Some of you may be just in this kind of in-between category where you see it and you kind of get it and you're just having a hard time pulling it off. And that's where it just comes back to, what do you want to do with your progress as a trader? Keep learning on your own, get some help, not get some help. That's all up to you. And as you know, I have the free stuff page out there to try and help you with, a lot of these concepts. But for a lot of people, it comes down to at some point they want to take a whole program and learn how to do this from scratch. And that's something you have to decide at some point. I want you to consider something else that's right along the lines I'm talking about here because I think it fits right in here. I think it fits in perfectly with what I'm talking about right here. Does a little bit of knowledge make a big difference? Does a little better knowledge make a big difference? How about just an answer to that question first of all? Does a little better knowledge make a big difference in anything, I guess? I'm asking about trading specifically. Does a little bit better knowledge make a big difference? Like if you're at 80%, you go to 90, does that make a 10% difference in your trading? Or is there some multiplier in there where the next 10% doubles your trading performance, right? To give you the analogy, I want to ask you this question. Does a casino make money from a blackjack table? Does a casino make money from a blackjack table? Sure does. Vegas is all lit up, not because they're losing money, right? Sure does, right? But I want you to think about this very, very carefully. Consider this. I know there's different games at a casino, but take blackjack. What are the odds in blackjack? What are the odds the house has in blackjack? What are the exact odds that they have winning percentage in blackjack? And I'm going on memory here on my info. Could be a little bit old with all the modern stuff today. Of course, it really shouldn't change. Yeah, 52%, exactly. 52% is the best they would possibly have. 52% winning is the best. And that's assuming the person, all the people at the table, know exactly how to play the game. In other words, if you read that book, when to take it, not take it, if everybody plays according to the book, the house wins 52% of the time. If you get a good card counter in there, obviously the card counter can get that to less than 50%, and that's why they do their best to try and weed out any potential card counters. But think about those odds. Those are not huge odds. That could be art today, with people getting more astute and possibly some cheating getting in there, right? I mean, I would agree with that. They're in the 1 to 2. As I said, 52% at best. 52% at best. There it is. So I want you to think about this. What if the casino did not keep up with surveillance technology? What if they just had fuzzy cameras? What if they had nobody really watching them to see if there's cheating going on? Remember, cheating is across the board. There are players that can be cheating. There are dealers that can be cheating. There are pit bosses that can be cheating. All kinds of stuff can go on. There's a lot of money going on here. What if the casino did not do background checks on the dealers it hired? What if the casino did not have well-trained pit bosses? In other words, if you just drop the ball on any little thing, how much do you think it would take before that 1 or 2% edge was gone? Art, how long do you think it would take if the casino was just managed poorly? Dealers came in with friends sitting at the table, sleight of hand, boom, 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 right? It wouldn't take long for the houses losing money pretty quickly. So I use this analogy. I don't know in trading what the equivalent of that 52% number is. It gets a little complicated because you start talking about expectancy. But here's what I do know is that I think it's very similar. In other words, there's not a lot of room for error in trading. Would you all agree with that? There's not a lot of room for error. You have to know what you're doing. You have to execute properly. You have to manage properly. You don't get to screw up a whole lot. Like I screwed up today. I had a bad day today. I screwed up today. I should have walked away at 10:30 today. I knew there's nothing out there, and I sat there and had a losing day today. But it happens once in a while. But it can't happen often. You just don't have that kind of odds. And what scares me is that you get those odds from understanding how to read a chart. And what scares me is when I see people that don't even have 50% of the knowledge to read a chart. Again, I talk to some people, and I certainly appreciate, you've heard me say many times, there's different ways to make money. And ways to make it consistently, I applaud. And even when you show me stuff, there's stuff I can say, hey, that works. It's not what I want to do, but it works. I can see how that works. But there's also stuff that's just wrong. And I talk to so many people that are just wrong. I mean, I maybe come off rude to some people, but I think I owe it to people who ask me questions to give them honest answers, not sugarcoat things. And if you're doing something that I just know for a fact, I bet my right arm, you don't have a chance of making money. I'm going to let you know. It's not for any other purpose other than to say, hey, go do something else. go deal blackjack at the casinos. Reading a chart is the only way to make money in the market for 99.999% of us. There's nobody here listening to me that can make money in the market in some other way other than technical analysis. And it's a great way to do it. It's a very reliable way to do it. I have one more thought. Make money on normal moves. Save some for the home run when appropriate. Do it by playing with the house's money. Like I just showed you the WB trade, right? 5 R's to target 1. My target 1. the top of the base. And if it goes to a real target one, it's 17.5 hours. So guess what? Do you know how easy it is to manage something when the worst you can do is make money? I mean, these long-term trades, I barely look at them. I mean, I just let them go. And is that theoretical? Well, no. I have this year, I had a 20R, not the whole trade, but the one target was a 20R target. I had a couple of 9R targets. So this is what I do, and I get to some of these. And it's great when you do. You don't always do it. Not every trade's like that, of course. But if you can get with a normal move to make some money, and then look for the exceptional move with some extra shares, they call that playing with the house's money, not to use another casino term, but playing with the house's money. You have no skin in the game left. And you know what? It makes it much easier to manage. Because most of you that have trouble managing, your hardest time managing is probably getting out of the gates when you just don't want to take a loss, and you keep getting stops really tight in the beginning, and you just choke yourself out of any potential trades because you don't want to go red on anything. And you just can't trade like that. And then I have a warning here. And I wanted to say 5 minutes for this warning. And actually, I don't think I've done this in the DTS. In the whole time I've been doing this, I don't think I ever finished one of these early, but I may be done 5 minutes early. Today's environment, read this line here, very important line. I'm going to keep pounding the table on this. Today's environment will train some of the worst traders in history. After the 1999 rally, 97% of all the top brokers trading day trading accounts were dormant. You know what dormant means? It means they're not being traded because there's like $100 in them and that's all that's left. In other words, they're broke. 97% of the quote-unquote day traders, the magical, wonderful, could never lose day traders in 1999 all went broke the next year. Why? Because the wonderful bullish market that can never go down, the market that will never fall, the market that will never crash, crashed, and everybody thought they were buyable pullbacks until they went broke. And I just want you to be careful if you're newer and you're kind of learning in this environment. What happens to some new people is, and you see some of these wonderful stories, these people sitting in these some chat rooms and making money and doing great with that. Well, that's great, but for every one of those stories, there's 3 people that's getting killed. And even the ones making money, what's happening is that they're just blindly going long some crazy stocks. If they don't work, they're just hanging on because they don't know what to do. They're just hanging on, and boom, 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 some of these go crazy. And you're making some money on them. That's great. But we are in what I call crazy town, where a lot of stocks, and if some of these that are taking off are the ones that keep going. It's a momentum market. So some people that are good jumping in on just insane entries are making money. But guess what's going to happen? When the insanity ends, that happens 1% as often, 5% as often. Right now, for every 20 stocks that goes crazy, there's going to be one. And you get in that late, and you're just going to get your head handed to you consistently. So I'm just a big, huge warning. Just be very careful. Track what you're doing. Make sure you know what you're doing, and you're not just getting lucky with a few, home runs by getting in the momentum market. This will not last long. Things will return to normal. And when they return to normal, there's going to be a lot of pain out there for a lot of people. Okay? I will be loving that day. Not everybody will be. Yeah, Caden, it's a funny thing. I'll take a minute and say this. Somebody sent me something. I didn't look this up, but somebody sent me something. I went to this page, and there was this link I couldn't help but to click on. It said, if you think Reddit is good, read this. And there was this whole slew of people in this room that were just talking about how they're just getting slaughtered. You hear the fun stories, and you hear the people that got in GME and took it from whatever 90 to 220. Guess what, guys? You know that's not going to last. And how many people did that? You hear the wonderful stories of people that did do that, and then you look at the charts of those type of things. You go, wow. But again, you're looking at the 1% of stuff that's happening. And I think the truth of it is that there's not that much stuff happening, that there's a lot of people that are not on the right side of it. Remember, for every winner, there's a loser. And regardless of who's doing okay with it, it's just simply not going to last long. What I like to teach people to do is just a consistent, boring style that makes money no matter what's going on. Market up, market down, market crazy, market boring, whatever it is. You just look for the right stuff. No matter what happens, at the very least, stocks are always meandering sideways. And you can make money doing that if you find those precise entries, you know what to do. All right? Do you have any questions? I actually believe that's my last slide. A couple of things while you're looking for that. Um, the the old special event video to watch of the day is from chart reader to trader investor. It kind of ties into what I'm talking about today to some degree, and you can find it if you go to the free stuff page. You all know where the free stuff page is, right? The free stuff page is right here. And if you go there, there's a newer Hall of Fame section. It's one of the Hall of Fame videos. If you're bored, take a look at that. Look at all of them on the free stuff page. Remember, on the free stuff page also, there is at the top of each section, there is also an archive page. You're just seeing the most recent videos. They go all the way back to the beginning of DTS. So take a look at that video. That's my recommendation for if you want to see another one. And also just a reminder for those of you who are interested in day trading but are not having the 25,000 necessary SEC required funds, there is a way you can do it with $5,000. You need to email me if you want to get some more information about that. I don't want to take the time to go over it here because it doesn't apply to most of you, but you can email me if you are interested in that. There's my email. Boom, 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 boom. If you're here, you're a member. I just told you about the free stuff page. And I'll leave that slide up. That's another video too, the three-legged stool. But that's what today is about in a sense, is understanding, superior technical understanding, math and probability, psychology and or experience. That's what you need to just make money from ordinary moves. How deep do you go into chart reading during the seminars? Ricardo, it is 100% all technical understanding of charts. Everything. What a question to ask. It's, Ricardo, it's almost like you're my straw man. Almost said straight man. It's almost like you're my straw man here. What a question to ask me since I have 5 minutes left. Ricardo, it is a complete, total, in-depth understanding of everything I can teach you. What is not in the seminar classes, and I'm answering Ricardo here. Don't yell at me. Don't stop me. I have to answer his question. What is not in the seminars is a bunch of crap that you never need. I could add 5 days to the seminar program and teach you 5 days worth of garbage that you'll never use, even though it's all true and accurate, and then say, oh, the seminar programs were so much more now because you get 5 days instead of 3 days. You're taught exactly what you need to make money, and you're taught in excruciating detail beyond what you will ever hear anywhere else. You repeat the classes over and over. There is coming the home study program now, I can safely announce by next month, at least for the first class. We get together with the practical application review day about every 3 weeks where we take and say, look, here's the trades I did, here's what I taught you in class, here's how we tie them together, because it's sometimes very theoretical when you're in class, and I want to take and say, look, everything I teach you is what I do is what I teach. You get everything and then you can get together with me and discuss when you do trades. So you're going to get everything that's in my head as much as you possibly can. It's all about chart reading. That's why the half-day class the Friday before covers peripheral stuff. That's why there is a seminar student resources page with peripheral videos so that we can take those 3 days and dive into charts and understanding technical analysis 100%. Okay? Did that answer your question completely and thoroughly? I normally never say that, but you asked the question, so there you go. Normally I have people just figure it out for themselves. Any other questions, anybody? From anything from today, from this, did you like it? Did it help you? Is it something to think about? Was it a waste of time? Feel free to tell me. It only helps me improve future things. WB had another daily retest. Do you see another entry then? My answer is going to be for a longer term trade, you mean? Not to me. No. Not to me. Because again, moment in time, David, to me means there's like one entry. You know what a moment in time is? It's ground zero. I got on this concept, at least explaining it this way, that if you look at some big move, and you go back to find its origins, where it technically was a sound origin, you can come down to a 1 minute chart, even on a monthly setup, and find the 1 minute that this was the birth of this move. From here forward, it did everything you wanted it to do. And there's only one moment like that. Now, obviously, David, there are other possible entries, but you're at the top of the daily range now, right? Matter of fact, somebody said to me yesterday in the room that WB is a short, and they're right. It was a day trading short yesterday. You're at a triple top high on the daily chart. Now, I don't think it drops very much. I think it does go higher, but you need to get some kind of entry from here. You can't just jump in blindly and just assume it's going to hold. Now, if you get some more red in the pattern, if you get a little longer sideways pattern in here, anything like that, you could possibly find an entry still, but it's not going to be as great of an entry. Here's the other entry, David. I just took a 5R target, and now you're getting in. How do you feel about that? On the same trade, right? I mean, that answers the question, right? Oh, around June 18th? Oh, you mean back? I thought you meant today. You didn't say back then. Yeah, you could have used June 18th, sure. I would not. I think it was a lower odds thing on June 18th because it's very hard to say if that pop was just a little technical pop or if it actually tried to get up there because it went about halfway. So it was a lower odds thing, but I think with the right entry, I would take it because, again, it's a little lower odds, but you get a great entry. It makes up for it to me. I always say I'd rather, and I know this stuns a lot of you, but I always say I'd rather have a great entry on a so-so pattern than a so-so entry on a great pattern. It's true. Yes, Caden, all of these Wednesday events, they all get posted to the DTS website and to the YouTube website on the same time, generally on the weekend following. And something you can do is if you like going to the DTS site, but you like the fact that you can be notified from YouTube, if you go to YouTube and then subscribe, you'll get a notification anytime DTS posts a video, and then you can go to either YouTube or to the DTS site to watch the video, whichever way you want to do it. All right, thanks guys. Have a great evening. See you later.